So today we are going to start capital gains tax. This is the first area of our syllabus. Okay, so capital gain tax will arise whenever there is a chargeable disposal of chargeable assets by a chargeable person. Whenever there will be a chargeable disposal of chargeable assets by a chargeable person, we are going to pay capital gains tax. So we will discuss all these terms in detail. First of all, we are going to discuss chargeable assets. So what are, chargeable disposals. So what are the disposals? Students, first of all, uh, I'm going to clarify the meaning of disposal. So please remember, disposal means transfer of an asset. Disposal means transfer of an asset. So asset can be transferred by any mean. Most of the students will confuse. They will take the meaning of disposal as just sale. So sale is also an example of the disposal. There are multiple ways in which you can transfer an asset. For example, your asset can be transferred with the disposal. Asset can be transferred with a gift. Asset can be transferred with a theft. So there are multiple examples of disposals. So disposal means an asset is regarded as disposed if its ownership changes. So if you have transferred an asset, it means you have made a disposal. For example, disposal of whole or part of an asset, that's an example of disposal. Next one, if you have made a gift, once again, ownership of the asset has transferred. So gift is another example. Gift is another example of disposal. Then loss or total destruction of an asset. If you have lost an asset, or maybe you have transferred an asset as a result of theft maybe. So once again the asset has transferred. So whenever the asset will be transferred, it will be considered as disposal. The next point which we are going to discuss is date of disposal. So how to determine, how to decide the date of disposal? Students, please keep in mind, please remember, in the UK, tax year runs from 6th April till 5th April. So our examinable tax year is 2019-20, and it will start on 6th April 2019 and it will end on 5th of April 2020. So in the UK, tax year will start from 6th April and it will end on 5th April. So date of disposal is very, very important, because if the date of sale or date of disposal of an asset will fall within our current tax year, we are going to pay tax on that asset. If the date of disposal do not fall in the current tax year, obviously we are not going to pay tax on that asset. So date of disposal is very, very important. So normally in the normal contracts, normally the date of contract or date of agreement is the date of disposal. For example, I'm going to sell a plant maybe. So if I'm going to sell a plant and today's date is the date of agreement, all the terms and conditions are agreed on today's date. So today's date is the date of sale for the seller and the date of purchase for the purchaser. So in this normal contracts, in the simple contracts, date of contract or date of agreement is the date of disposal. But there are few contracts which are called contingent contracts. So contingent contracts are the contracts which will depend upon certain conditions to become legally binding. For example, I'm saying I will sell a building if the profit of my business will be 1 million in the current year. If the profit of my business will be 1 million for the current year, only then I will sell a building. And I have agreed all the terms and conditions for the disposal of the building. What would be the selling price, what would be the consideration, what would be the cash consideration, what would be the terms. So all the terms and conditions are settled, but the only thing which needs to be confirmed is a condition. It needs to be confirmed is a condition that I'm only going to sell this building if the profit for the current year will be more than 1 million. So in order to become this contract legally binding, this condition must be satisfied. So contingent contracts are the contracts which depends upon certain conditions to become legally binding. So in this case, if the contract for the disposal is a contingent contract, so the contingent contract will become legally binding when the date on which all the conditions are satisfied. So for the contingent contracts, we need to wait for the conditions to be satisfied. So, and the date on which all the conditions will be satisfied, that date will be the date of disposal, date of sale for the seller, and it would be date of purchase for the purchase. Third case is death transfers. If an asset has transferred to another party as a result of death of an individual, for example, if a person has died and property of the deceased person has transferred between his family members as an inheritance. So in case of inheritance, in case of death, so students, please remember, CGT is a lifetime tax. CGT is a lifetime tax. We will pay CGT on those transactions, on those transfers which we will make during our lifetime. So if an asset has transferred after the death of an individual, it is called death transfer, and CGT is just not applicable on death transfers or transfer to charity. If you are going to transfer any asset to charity, so if an asset has transferred to charity, maybe as a donation, so in that case CGT is not applicable. So these two types of transfer of assets are outside the scope of capital gain tax. So in these two circumstances, CGT is just not applicable. So no CGT implications in these two cases. And now, so these are the examples of date of disposal. So there are three types of date of disposal. So there are there may be three situations, three different situations. So there may be simple contracts, there may be conditional contracts, there may be death transfers. The next point is disposal proceeds. Disposal proceeds means selling price. So what would be the selling price? So we have discussed the examples of transfer of an asset. So we have discussed the different examples of transfer of an asset. So now we are going to learn what would be the selling price in different situations. For example, if we have transferred the asset as a result of the gift, what would be the selling price in case of gift? Because in case of gift, we are not going to receive anything from the purchaser, from the donee. So what would be the selling price in different situations? For example, first of all, if we have sold an asset at market value, at arm's length transaction, arm's length means market value. If we have sold an asset at market value, then obviously, because we have sold the asset at market value, the actual selling price will become the disposal proceeds in this case. No issue at all. So if we have sold an asset at market value, then obviously the selling price received will be disposal proceeds. Okay, so the next one, not sold at arm's length. If we have not sold an asset at market value, this is the example of gift. In case of gifts, We have not sold an asset at market value. So if we have not sold an asset at market value, so in these situations, what would be the selling price? Friends, please keep in mind, there are two types of gifts. Normally, whenever the term gift is used, normally we think transfer of an asset without receiving any consideration, transferring an asset free of cost. Students, please remember, if you have transferred an asset without receiving any consideration, it is gift. But if you have sold an asset below the market value, it's also an example of the gift. For example, if an asset has market value of £10,000 and you have sold this asset for £7,000, I'm repeating once again, if an asset has market value, if an asset has market value of £10,000 and we have sold it for £7,000, so what will happen? Still there is a gift element. For example, if market value of an asset is, say, £10,000 and we have sold it for, say, £7,000. So you can see, even though the market value is £10,000, but we have sold this asset for £7,000. So there is still a gift element. There is still a gift element of £3,000 over here. So please remember, whenever the sale at undervalues, whenever the term sale at undervalue is concerned, it's also an example of gift. So there are two types of gift. One is asset transferred free of cost, free of consideration, and the second one is sale at undervalue. So sale at undervalue is also an example of gift. So students, if there is a transaction between husband and wife, so in case of husband and wife, in case of transaction between husband and wife, we will ignore the selling price, even though husband and wife are selling the asset at market value, still we will ignore the selling price. In case of transactions between husband and wife, we will ignore the selling price. In that case, disposal proceed will be equal to cost. So there will be no gain, no loss. So in this example, if this would be a transaction, suppose if this would be a transfer between spouse. So husband sold this asset to wife for £7,000. The husband has sold this asset to wife for £7,000. So this is the normal solution. So what would be the difference if this would be a transfer transaction between husband and wife? So students, please remember, whenever there will be a transaction between husband and wife, we will ignore the actual selling price. In that case, cost will become disposal proceeds. So what is cost? £4,000. What was the actual cost? Once again, £4,000. So what is the gain? Nil. So whenever there will be a transaction between husband and wife, friends, please remember, there will be no gain, no loss. Say this transaction is from husband to wife. Husband had sold the asset to wife. Say, for example, or let me write it down. Over here. So, if the husband has sold this asset to wife, these are the tax implications for the husband and for the wife, because this is a transaction between husband and wife at cost. So, because now wife owns this asset, what would be the cost for the wife? 4,000 pounds. So, whenever there will be a transaction between husband and wife, it will be recorded at cost. So cost of the husband, which was 4,000 pounds, will become the cost for the wife. And for the husband, there will be no gain, no loss. So these are the different cases to determine the selling price in different situations. So, yes, another very good question. Students, tax law has nothing to do with the depreciation. Tax law has nothing to do with the depreciation. In the tax law, we will consider only actual cash inflows and actual cash outflows. Because depreciation is a non-cash item. So in the taxation, most of the time, not always, but in most of the time, we will consider cash inflows and cash outflows. Tax is based on actual figures. Okay? So next term is chargeable assets. So all assets are chargeable assets except those assets specifically stated by the tax law that these are exempt. So all assets except exempt assets are called chargeable assets. So there is a list of exempt assets. First of all, motor cars. So please remember, all types of motor cars are exempt in the capital gains tax. So whenever the word car will be used, you don't need to calculate anything, just write down the word car, and in front of that car, just write down the word exempt. That's it. So National Saving and Investment Certificate, you can say it's kind of prize bond which UK government issues. So National Saving and Investment Certificate, if you will see this word, it is exempt from tax. You don't have to pay tax on profit on these certificates. Next one, cash, debtors, inventory, all the current assets are exempt in capital gains tax. Decorations awarded for the bravery, please remember, any medal, any reward for the bravery, maybe if you are an army personnel, or if you even though if you are not on any position, if you are receiving any award from the state, it will be exempt. Damages for personal injury, for example, if the insurance company, if obviously if your life is insured and you are as a result of any damage, you are receiving anything from the insurance company as a result of personal injury. So if you are receiving anything from the insurance company as a result of personal injury, you don't have to pay any tax. Please remove this point. I will exclude this point from your notes. Shares in VCT, these are special types of shares and these are exempt in capital gains tax. VCT are a special type of shares and all types of VCT are exempt in capital gains tax. So, endowment policy proceeds. Endowment policy is normally a government fund for the poor people. So, if you are receiving anything from the endowment fund, it will be exempt. Foreign currency for private use. If you have foreign currency and you have exchange gain or loss on that foreign currency, so there will be no tax on exchange gain or loss, because currency means cash and cash means current assets. So all the current assets are exempt in the capital gains tax. Work of art for the national use. For example, if you draw a portrait for your national hero, or maybe if you draw something for a national event, so any work of art for the national use will be exempt. Gilded securities, students, this is another type of debt, you can say. This is another type of the bond, so it will be exempt as well. So there are different types of bonds. This is almost, you can say this is similar to price bonds. This is a type of debt, these are exempt. Qualifying corporate bonds, once again these are bonds, these are exempt. Company loan notes, once again type of debt, exempt. So please remember, all types of investments in the debt instruments are exempt. Either these are bonds, either these are some type of certificate, either it is loan notes or debentures. So all types of investment in instruments are exempt in the capital gains tax. Some chattels, some chattels. There is a complete topic on the chattels. I'm leaving it for a while now. I'm leaving it for a while. So you can say some chattels, it is included in the taxable category in the above paragraph as well. So there are few taxable assets. There are few examples of the taxable assets. These are the examples of exempt assets. So we will cover chattels in detail when we will cover the topic of the chattels. Few chattels are exempt and few chattels are taxable. Then investment in, students, this is typing mistake. This is not NISA, this is ISA. Its old name is NISA. Old name was NISA and now N has removed. In fact, it is ISA right now. This is the appropriate word. ISA stand for individual saving account. ISA stand for individual saving account. It is type of bank account, and if you have invested in this bank account, if you have kept your money in this bank account, any return from this bank account will be exempt. Pricing and betting winning. Students, please remember, betting is allowed in the UK, and if you will win a bet, you don't have to pay any tax. So these are the examples of exempt asset. So in this paper, you have to memorize everything. There is no other option. So you need to memorize all these points. So these are the list of exempt assets. So you need to memorize. You need to memorize this list. You need to memorize this list, and all assets which are not part of this list are called chargeable assets. So I have not mentioned all the assets. I have just given few examples over here. I have just given few examples of the chargeable assets over here. For example, land and building is a chargeable asset. Goodwill is a chargeable asset. Short-term lease, long-term lease. If you have taken an asset on lease, it is once again chargeable asset. Unquoted shares, quoted shares. If you have purchased shares, so shares are chargeable assets. Unit trust. Shares of a trust are called unit trust. These are chargeable assets, and some chattels. Chattels are chargeable assets. We will cover the topic of chattels in detail, but later on. The next term which we are going to cover is chargeable person. So we have discussed this term already, but over here, an individual is resident in the UK, he is liable to pay UK CGT on his worldwide gains. So if an individual is UK resident, he has to pay tax on all of the assets. Either the assets are in UK or the assets are in overseas. In both cases, a UK resident person has to pay tax on all of the assets. A UK resident person has to pay tax on all of the assets either in the UK or in overseas. But if a person is not UK resident, if a person is not UK resident, he will not pay CGT in UK, not even on UK assets. But there is an exception over here. There is an exception over here, that is land and building. I will add a land and building over here when I will send you the updated copy of these notes. I will share these notes in the WhatsApp group before our next class. So before our next class, I will share the updated notes in our WhatsApp group, and obviously I will update all these typing errors. So if a person is UK resident, he will have to pay capital gain tax in the UK on his UK as well as overseas assets. But if a person is not UK resident, he will not pay any tax on UK assets, he will not pay any tax on overseas assets apart from one asset. And what is that asset? That is land and building in the UK. If a non-resident person has land and building in the UK, only then he has to pay tax on that land and building. Otherwise, non-resident person will not pay any tax in the UK. Moving forward, how to calculate gain or loss? How to calculate gain or loss? So let's, for example, calculation of capital gain or loss. So how to calculate gain or loss? For example, let's take building as an example. Let's take building as an example. For example, I have purchased a building. So cost of the building is say 2 lakh. So suppose we have purchased a building and the cost of the building is say 2 lakh. So at the time of the purchase, we have incurred few extra costs. These are called incidental costs. So we have sold asset number 1, we have gain of 75,000 pounds on asset 1. We have sold asset number 2, we have loss of 200,000 pounds on asset 2. There is net loss of 125,000 pounds. So if there is net loss, we don't need to pay any tax. If there will be net gain over here, we have to pay tax. Let's come back to the notes. How to calculate gain or loss? First of all, we will write down selling price. Then we will deduct incidental cost at the time of the sale of the asset. We have net disposal proceeds. From net proceeds, we will deduct purchase price. We will deduct incidental cost at the time of the purchase. We will deduct capital improvements. We have capital gain or loss. We will pay tax if there is capital gain. And if we have capital loss, obviously we will not calculate any tax. Okay, so next one is purchase price. So what would be the purchase price? Normally, purchase price means the consideration paid at the time of the purchase of an asset. So purchase price means purchase price. Purchase price will be market value if you have received an asset as a gift. So if you have received an asset as a gift, in that case, market value will become your cost. Next one is incidental costs. Friends, we have already discussed incidental costs. Equally, if in the previous year we have capital gains, obviously we will pay tax in the previous year, and in the current year we have capital loss, we will not pay tax in the current year. Okay, now let's move towards the calculation of capital gain tax. How to calculate the tax? You can see over here. First of all, we will write down the gains of the asset we have sold during the year. So if we have sold different assets during the year, we need to calculate gain or loss at the date of disposal, but we will prepare this pro forma for the whole year. Gain or loss will be calculated at the date of disposal, but tax will be calculated for the whole year. So this pro forma will be made at the end of the year. So during, if we have sold different assets during the year, we will write down gain of the all assets over here. And obviously, we will deduct capital losses on all of the assets. We have net capital gain. Just like the example we have just discussed, we have capital loss of £125,000. So if we have capital loss over here, we will not pay any tax. But if we have net chargeable gain over here, then what to do? So let me explain. For example, this is 2018-19 tax year. So this was 2018-19 tax year, and 2018-19 tax year, students, you can see over here, we have capital loss of £125,000. What about 2019-20? So students, in 2019-20, we have, once again, we have sold different assets. We have sold, say, asset 1. It can be any asset. So on asset 1, we have gain of, say, £60,000. In 2019-20, we have sold another asset, asset 2, and we have maybe loss of, say, £10,000. Say, now you can see we have net gain of £50,000 in 2019-20 tax year. Over here, we will deduct annual exempt amount. So what is annual exempt amount? So it is a fixed relaxation available to every individual every year. Annual exempt amount is a fixed relaxation available to every individual every year. You can see its amount is £12,000. It is a fixed relaxation. So this is, once again, this is a typing mistake. It should be over here as well. This is annual exempt amount, and over here it is amount of 12,000 pounds. So it is a typing mistake. When I will send these notes, obviously I will correct this typing mistake. So what is annual exempt amount? Students, please remember, it is a fixed relaxation of 12,000 pounds. So now the remaining gain is 38,000 pounds. Over here, we can deduct our brought forward capital loss. You can see we have brought forward capital loss. We have brought forward capital loss of 125,000 pounds. This one. So please remember, your capital loss will never waste. If you have net capital loss, just like in 2018-19, you can see you have net capital loss of 125,000 pounds over here. So if you have net capital loss, it will be carried forward and it will be adjusted in the next years. So we have brought forward capital loss of 1,25,000 pounds, of which 38,000 pounds will be adjusted in the current year, and this is called taxable gain. This is your taxable gain. Unfortunately, 0. This is your taxable gain. And what is the remaining capital loss? Capital loss carry forward to 2020-21. What was total loss? Students, your total loss was 1,25,000 pounds, of which 38,000 pounds has been adjusted over here. So the remaining loss is just 87,000 pounds. We will deduct this remaining loss of 87,000 pounds from the next year, 2021. So we will keep on carrying forward this loss until this loss will be relieved. We can carry forward this loss for an indefinite time period until we will be able to deduct this loss. So this was the treatment of capital loss as well. So what is the treatment of capital loss? First of all, we will net off capital gains and capital losses. You can see over here. First of all, we will net off capital gains and capital losses. If there is net capital loss, you can see over here, if there is net capital loss, this loss will be carried forward and deducted from capital gains of the future years. And we can carry forward capital loss for indefinite time periods. So unfortunately, in this example, taxable gain is 0. But if there will be taxable gain over here, we will pay tax on that gain. Students, if you have any questions, you can ask. So in this way, first of all, we will net off all of the gains. For example, if we have sold 4-5 assets, we will add all of the gains of the current year. We will deduct all of the losses of the current year. We will deduct annual exempt amount for the current year. I am repeating once again, it is £12,000. We have net capital gain. After that, we will deduct brought forward losses. We have taxable gains. We have to pay tax on this gain. Kohli treatment is very simple. We will add both years' capital losses, that's it, and deduct it from the third year. If in the year 1 you have net loss, in the year you have once again loss, you will add losses of both years and you will deduct it from the third year. Before moving forward, I'm going to explain two terms. Please be attentive. Taxable income. I'm going to explain 2 points. I'm just going to explain 2 points of income tax which are relevant over here. Taxable income. If we want to calculate, and I'm repeating once again, these points relates to income tax. So first of all, how to calculate taxable income? If you want to calculate taxable income, you just need to add all of the incomes of an individual. Add all incomes. So there may be multiple types of incomes. An individual may be earning interest. Maybe an individual is earning interest. Maybe an individual has employment income. Maybe an individual has rental income. Maybe an individual has trading income. So there are multiple types of incomes. So we will add all incomes of an individual less personal allowance. So just like capital gains tax, we have discussed over here what is annual exempt amount. Students, annual exempt amount is a relaxation available every year. Annual exempt amount is a relaxation available to every individual every year. So just like capital gains tax, a fixed relaxation is also available in the income tax amounting to £12,500. So a fixed relaxation is also available in the income tax. So for example, we need to add all of the incomes of an individual. Say when we will add all of the incomes of an individual, say the income of an individual is £70,000. When we will deduct fixed relaxation, we have taxable income. Treatment is very simple. So we have taxable income. We have taxable income of 57,500 pounds. Now, why we are going to cover this point? The next term which I'm going to explain is basic rate band. Students, basic rate band is a level of tax. As the name explains by itself, basic rate band. This is a band, this is a level of tax in which rate of tax is comparatively lower. And its amount, this level has a fixed amount of 37,500 pounds. But this is a combined level for income tax and CGT, used in capital gain tax if not 100% utilized in income tax. You can see what is the income, 57,500. It means we have to apply tax rates on income of 57,500 pounds. Our income in the current year is, you can see over here, our taxable income in the current year is 57,500 pounds. So it means we have to apply the tax rate on 57,500 pounds. So what is basic rate band? It is 37,500. So it means the income has fully utilized this level. So this level of basic rate band has fully utilized in the income tax. So it is not available in the capital gains tax. Say for example, so the basic rate band available for CGT is 0. Because we have our taxable income, is more than 37,500. That's why basic rate band has fully utilized in the income tax. I am going to write it down over here as well, because taxable income is more than 37,500. Because our income is more than 37,500 pounds, that's why this band has fully utilized in the income tax. So basic rate band is not available for the CGT. So lower rate of tax is not applicable in the CGT. Ibrahim, obviously, you will always, first of all, you will utilize your basic rate band in the income tax. If it is unused in the income tax, only then you can utilize it in the capital gains tax. So let's consider another example. Let's consider another one. For example, say our taxable income is 40,000 pounds. Our taxable in our total income is 40,000 pounds. We will deduct the relaxation, which is 12,500. So our taxable income is 27,500. What is basic rate band? 37,500. So now, what is unused amount of basic rate band? You can see basic rate band is 37,500 while income is less than 37,500. So basic rate band is unused by 10,000 pounds in the income tax. So this 10,000 pounds will be utilized in this capital gains tax. So this is basic rate band available for CGT. So the basic rate band available in the capital gain tax is 10,000 pounds. Now let's move towards taxable gains. How to calculate taxable gains? I'm moving towards that point. Don't worry. We have just learned how to calculate unused basic rate band. Are you able to understand the calculation of unused basic rate band? Is it clear now? How you will calculate 10,000 pounds? Okay. So, Ibrahim, very good question. Very good question. If the current year tax is nil due to brought forward capital losses, why do we look for the 10,000? Obviously, if your taxable gains are zero, if you don't have any taxable gain, just like over here, if you don't have any taxable gains, then obviously you don't need to calculate unused basic rate band. Unused basic rate band is relevant when you will calculate basic rate band will be relevant when you will calculate the tax. If your taxable gains are zero, you don't have to calculate the basic rate band. The basic rate band is a rate of tax. Got it? Okay. So now we are moving towards taxable gains. The next point is how to calculate taxable gains. So we have just learned the calculation of taxable gains. So now let's discuss a complete example in which we will calculate not only taxable income, but we will also calculate the taxable gains. Okay. So for example, Mm, okay. So, for example, in 2019-20, first of all, if we will discuss the performer in detail, in the first line you will write down Mr. A. This would be your top line. So, Mr. A capital gain tax computation, and right now we are calculating the tax for 2019-20. So, Mr. A capital gain tax computation for 2019-20. For example, we have sold an asset 1. We have sold an asset 1. We have capital gain of £60,000 on asset 1. We have sold an asset 2. We have loss of £10,000 on asset 2. After that, we have net loss. We have net loss or a net gain of £50,000. Then we have deducted annual exempt amount of £12,000. We have net gain of £38,000. After that, suppose we have brought forward capital loss of say just £8,000. We have brought forward capital loss of only £8,000. So we have deducted brought forward loss. So now we have capital gain. We have capital gain of £30,000. We have to pay tax. We have to pay CGT on this £30,000 because we have taxable gain. And whenever you have taxable gain, it means you are going to pay tax. So now let's move towards the working. So working number 1. So in this working, we will calculate unused basic rate band. So this is the working for unused basic rate band. So for example, what is the first step? Add all incomes of an individual. So first of all, we are going to calculate taxable income. So in order to calculate taxable income, you need to add all of the incomes of an individual. Say, for example, an individual has employment income of say £20,000. An individual has interest income as well. Say £5,000. No, not interest income, say trading profit. So this individual has two incomes. Employment income of £20,000, trading profit of £5,000. So this individual has total income. Of £25,000. We will deduct personal allowance over here. As you all know, we have fixed amount of the personal allowance, which is 12,500. So after that, we have taxable. After that, we have taxable income. So we have taxable income of 12,500. Let me change it because these are the same values and you will confuse later on. Let's make it 6,000. So employment income is £20,000. Trading profit is £6,000. Total income is £26,000. Personal allowance, this is a fixed relaxation in the income tax. We have deducted fixed relaxation of £12,500. Now we have taxable income of £13,500. Now let's calculate unused basic rate band. Students, as you all know, basic rate band has fixed amount. Basic rate band has fixed amount of 37,500 pounds. When we will deduct 13,500, this is your answer. So the unused basic rate band from the income tax is 24,000 pounds. Students, if anybody has any confusion, you can ask. How 24,000? 37,500 minus 13,500. So from the income tax, basic rate band is unused by 24,000 pounds. Students, if anybody has any confusion, you can ask. So now, let's apply the tax rates of CGT. Students, unused basic rate band will be taxed at 10%. We will apply 10% tax rate on unused basic rate band, and on remaining gains we will apply a tax rate of 20%. Students, you can see our total taxable gain is 30,000 pounds. So out of 30,000 pounds, we will apply 10% tax rate on 24,000 pounds, and on remaining gain equal to 30,000 minus 24,000. Remaining gain is 6,000. We will apply 20% tax on remaining 6,000. So on 24,000 pounds, tax rate is 10%, equal to this one multiplied by this one. So on 24,000 pounds, tax rate is 10%, which is unused basic rate band. So you can see over here, there is a lower rate of tax for unused basic rate band, and there is a higher rate of tax for remaining gains. So after adding both these gains, you can see we have applied tax rate on the total gain. Our total gain is 30,000. We have applied the tax rate of on full amount of 30,000 pounds. This is our total tax. This is called CGT liability. Students, you can ask if you have any confusion. It's not that technical. You just have to calculate unused basic rate band. Total gain, total taxable gain is 30,000. You will apply lower rate of tax on unused basic rate band, and you will apply a higher rate of tax on remaining taxable gains. Students, are you able to understand this example? Tell me if you have any confusion. If you have any confusion, you can ask. So students, we have learned the treatment of capital loss as well. If capital losses are deducted from capital gains of the same year, and any unrelieved capital losses, means remaining capital losses, will be carried forward and deducted from future capital gains, but up to the level that annual exempt amount of future years do not waste. Means first we will deduct annual exempt amount and then we will deduct brought forward capital losses. You can see over here as well. First we will deduct annual exempt amount and after that we will deduct brought forward capital losses. You can see this point in the previous example as well. You can see over here as well. First, we have deducted annual exempt amount and after that we have deducted brought forward capital losses. Okay, so the rates of tax, you can see. What are the normal rates? Normal rates are 10% and 20%, falling within the basic rate band. So on basic rate band, tax rate is 10%. In excess of basic rate band, normal rate is 20%. Residential property rates. If an individual has residential property, if an individual has any residential property, so students please remember, rate of the residential property is bit higher. Instead of 10%, it is 18%, and instead of 20%, it is 28%. So let's discuss an example on residential property gains as well, and that would be the last point for today. Yes, Kuli, you are right. This is the only way to calculate capital gain tax. CGT on residential property. So we are going to discuss capital gain tax on residential property. How to calculate capital gain tax on a residential property. Say for example, we have capital gain residential property, and there is no capital loss. Straight away I'm giving example of capital gain. On residential property, say we have capital gain of £20,000. And we have other capital gains other than residential property. So other than residential property, we have capital gains of say £40,000. Apart from these gains, we have brought forward capital loss. So we have brought forward capital loss of say £15,000. So this is a small example. let's increase our gains a bit. Mm, 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 mm. Yes. So this is a small example. What is the requirement? CGT liability. We are required to calculate CGT liability, and income of this individual is nil. So this is a small example. We are required to calculate capital gain tax liability, and please remember income of this individual is 0. So let's solve this one. So first of all, we will net off our capital gains and losses, and please remember, whenever you have gain from residential property, please prepare two separate columns. One column is for other gains and one column for residential property, because tax rates are different for both types of gains. So one column for the other gains and the second column for the residential property. Okay. So students, we have other gains of £40,000, and we have gains from residential property amounting to £50,000. Now, we don't have any capital loss in the current year. These are our total gains. So we will, before deduction of brought forward capital losses, we need to deduct annual exempt amount. Now, what is your opinion? As you all know, annual exempt amount is a fixed relaxation of £12,500. So what is your opinion? What do you say, students? Whether I should deduct this annual exempt amount from other gains or from residential property gains? What do you say? What is your suggestion? Whether I should deduct annual exempt amount from gains of residential property or other gains? So we will deduct it from residential property gains first. If gains from residential property are just £5,000, then the remaining annual exempt amount will be deducted from other gains. Can you please tell me the reason why we are going to do deduct annual exempt amount in this way? What is the reason? What is the logic behind this? So the logic is very simple. Tax rate is higher. Tax rate is higher on residential property, so we need to reduce the gains of residential property. Otherwise, we have to pay higher tax on the residential property. So, annual exempt amount, it has fixed amount of £12,000, so we will deduct it from gains of residential property. That's it. So these are taxable gains. Now, can you please tell me what is the unused basic rate band? Can you please tell me what is the amount of unused basic rate band? Everyone? because this individual do not have any income. So if the income is zero, obviously 100% basic rate band is unused. So you can apply the tax rates either on other gains first, on residential property gains first. Answer will be same. You can apply the tax rates in whatever the sequence you want to apply. So in either sequence, you can please try to solve it in both. First, you can apply the tax rates on other gains first. Alternatively, you can apply the tax rates on residential property first. And your answer in both cases will remain same. So now, tax rates, it's your choice. Unused basic rate band. So amount of the unused basic rate band is 37,500. And tax rate would be lower, 10%. So first of all, we are applying tax rates on other gains. And what is the remaining gain? You can see total gains are 40,000 minus 37,500, and we are done with other gains. So on these remaining gains, tax rate will be 20%. So on first unused basic rate band, tax rate is 10%. And on remaining gains, tax rate will be 20%. What about residential gains? Because we have already consumed the basic rate band, so tax rate on the residential gains will be 20%, 28% straight away. So as you all know, tax rate on the residential property is 18% instead of 10 and 28% instead of 20. So that's it. This is your CGT liability. Students, if you want to ask anything, you can ask. So we are done with the fundamental concepts of CGT, how to calculate capital gain, how to calculate capital gain, how to calculate capital gain tax, how to apply the tax rates. So we are done with the fundamental concepts of the capital gains tax. If you have any confusion, you can ask.